Hello, everybody. Here back to our webinar series, JFD Power Webinar. Today with the topic trading from the perspective of a broker. But first of all, have a warm welcome and all the best for the year 2018. So that's already part of my typical announcement for the record. So today is the 4th of January 2018. It's the first webinar this year. And I hope that you have good trades this year, maybe as before, but maybe from now on a little bit more profitable. However, it looks really for you. It's for me a pleasure to have you here. And speak. My name Stefan Friedrichowski is speaking, and just call me Stefan. If you get in touch with me via email, you see my contact here already. It's my email address at JFD Brokers, s.friedrichowski. It's a really complicated last name. Sorry for that, at jfdbrokers.com. If you have any further questions or if you want to have slides, previous webinars, Excel sheets, don't hesitate to get in touch with me directly with that email address. A warm welcome in the name of JFD as well. And you see the title, Trading from the Perspective of a Broker. That's the reason why I mentioned JFD already here. It has a special reason that I say trading from the perspective of a broker. It's not directly from the perspective of JFD. It's meant different here. What I want to have here within that webinar is that you change your perspective, that you don't think about trades being a trader. That's what you normally do. But maybe for the next 60 minutes, change your perspective and think about you are a broker. And that's my invitation for today. Thinking as a broker, and let's look what we do if we are on the other side. So you will often hear wordings like today, I am a broker. And I mean that really in that sense, thinking I am the broker. Honestly, I am not the broker, and I'm not the broker JFD. That's not my business. I'm responsible for trading strategies, so I'm not on the execution side. But my invitation is change your perspective. That always might be an eye-opener. And let's see what you think after the webinar. As always, you find already the slides from today's webinar in the GoToWebinar control panel. You can download those slides if you want. It's a PDF document. The webinar is recorded as always, and you can find the recordings of the webinars on the JFD YouTube channel. And that's exactly what you press in Google if you want to find it. It's simply YouTube JFD. That's all you need to look for, and then you will find all the recordings of previous webinars. And from tomorrow morning onwards, you will find the recordings from today as well. Many thanks for the greetings and Happy New Year sayings here in the chat function of GoToWebinar. Thank you very much. And you can use the chat as well for any questions later. If you have those, just write them down there. The other thing, as usual, I have to mention this slide. As always, that's a risk disclaimer. Honestly, today we really don't talk about trading strategies, and maybe you will later realize, hey, I talk about trading strategies as well, but now from the perspective of a broker. Totally in line with my invitation. Today we are a broker, and we think as a broker, and you personally should think as a broker as well. But nevertheless, I have to show always a slide here. So finally, if it comes to trading, you always trade on your own. I think that's starts explaining, and that's said. Let's look for another disclaimer. Today, I want to mention another disclaimer. It's not really a disclaimer. It's simply a statement of what I do here today, because I will open some opportunities, but everything is theoretically. What I don't want is that anybody should claim, hey, Stefan stated brokers are doing this and that. No, that's not meant. It's all everything here is theoretically, and I have no idea what's really used in reality. I don't know. But let's think what can be done. So, what are the topics of today? As mentioned, we start with the idea of let's change our perspective, and we will do it really stepwise, meaning we want to execute trades, but now it's not our trades. We are the broker, we have clients, and clients have trades. And those trades will be processed to us, and then let's look what we can do with those trades if they enter our sphere, meaning our computer, because everything is done here electronically. But before we really start with that idea, let me introduce a few terms within brokerage that we know exactly what we are talking about. And you see MM and STP, ECN, DMA. So I simply want to introduce shortly those terms, because you will find those terms on websites of any broker as well, and then you have maybe and hopefully a better idea of what stands behind those terms. And then we start our business. So we get a trade, and we will execute that trade in my company, because now we are a broker. Therefore, I write down here my company, because so I'm the head of the company and I'm the broker. After we have done one trade, let's look for 1,000 of trades. And later we will think more about our possibilities, what we can do, even that we have a view on how to do marketing. But you will see, it depends on what kind of broker we are. So a lot of things might happen today within those 60 minutes. Stay tuned, hopefully. And if you have any questions, no problem, just write them down here in the chat. Okay, so I want to start with those terms. And the first here is the MM. MM is quite simple, stands for market maker. That sometimes is already meant negative, which is not the case. Market maker is nothing from first principle negative. No. That I don't want to have here within the webinar, but we have possibilities, and those are discussed later. Market maker, they have a so-called dealing desk, and to make long story short, what a market maker is somebody who makes the price. That's all. So actually, I don't know exactly, but maybe euro US dollar right now is at 1.20. I'm not sure. But looking for trading, it means a market maker makes the price. And if in principle the market maker is saying the price is 125, then the price is at 125. You may think, oh, that's curious, or that's strange. But think about another situation. If you are at an airport and you want to exchange money, maybe from euro in US dollar, you go to an exchange counter, and then you place on the table your 100 euro, and you can expect some dollars in return. And how many? It will be on the table, and maybe there's written 1.05, maybe there's written 1.10. Whatever there's written, you will get. And if the nice guy behind the counter is changing the price, you get a different amount of dollars in return. So in this case, your counterpart behind the counter, he is making the price. And it's the same what a market maker is doing. Sounds maybe misleading. Of course, they will follow the normal market situation. That's not a fantasy price, but he's making the price. You need a special license if you are a market maker. And maybe a good question always is to your broker, do you have a license for being a market maker? And if the answer is no, which is good, at least from my perspective. And for example, for JFD does not have a license being a market maker, so definitely they are not a market maker. You will not find market maker that present of or that obvious on web pages, but if you look a little bit around, then you can get a feeling whether you have a broker being a market maker, yes or no. In most cases, you can realize it simply by looking to the trading conditions. And in most cases, don't take it for 100%. In most cases, if you have spreads only, then the probability is high that your counterpart is a market maker. But that's not a guarantee, and vice versa as well. So that's a market maker. And you see I have here a dotted line already in between the next three terms here, because those terms, STP, DMA, and ECN, sometimes they are really mixed up. For example, JFD is a so-called DMA STP broker. And you find nearly every combination out of those three. But more or less, what's meant here, and it's not, don't take it 100%, but what's always behind is that your order as a trader, when you press a button, the order will receive the broker, and then that order from you is processed. It's processed to a pool of banks or so-called liquidity providers. And I want to mention already here, it's always good if that pool is huge, or at least it's not a single bank, or it should be 10 or 20 who are standing behind that pool. So your order is really processed to that pool, and I will come to what happens there later. And that means your broker is more acting as an agent when it comes to order processing. So he's forwarding your order to that pool, and finally executed is your trade at that pool, not at the broker. And there are different kind of ways for this STP. DMA means direct market access. It's more or less saying that your order is directly processed, forwarded to that pool. And there's one additional possibility, which is called ECN, Electronic Communication Network. And if you have a broker like that, then your clients, you as a trader, you have direct access to that liquidity pool. Normally, so most brokers or most of us will not have that opportunity because typically then you have different trading conditions. Maybe you don't have any more 0.01 lot trading for Forex. The good thing is you can see the order book within that liquidity pool. But in most cases, it's not applicable for us as being a private trader. How can you identify brokers like that? In most cases, once again, it's not 100%, those brokers offer spreads plus commission. Firsthand, it sounds like, hey, extra costs. Why do I pay commission? Yeah, on the other hand, the spreads are much lower than for the other one. And if you normally add up spreads plus commission, then it levels the spread-only conditions at a market maker. There are differences. Sometimes the one is cheaper than the other one, sometimes vice versa. But in general, you can identify those STP brokers, and from now onwards, I always call those brokers here STP, straight through processing, meaning your order is processed in that pool. And normally, as in the case for JFD, you have spreads, low spreads, plus a fixed commission. per lot or whatever unit. And I will make all the differences up from now onwards only with two definitions, market maker and STP. So that's some terms out of the brokerage scene. And now let's start our business. We are a broker. So therefore, we change perspective. So there's a client, so it's not anymore you, because you are now the broker itself, and a client trade comes to me. Practically, it means maybe there is a trader sitting in front of an MT4, pressing the button, and what he tries to do here is to buy one lot long euro US dollar. So I'm sitting at my computer in my brokerage home place, and I get that order from that client. Okay. It's just a question here from somebody from out of you. Order book from outside is available to brokers, depends on market. Yeah, there are special brokers who have that kind of access, and there are some, but only very few, who give that information direct to clients. So that's just a remark out of the chat. So there's a client now buying one lot euro US dollar. And as always, if you open a long trade, then you open that trade on the ask level. And to make my further calculations a little bit more easy, I pushed the exchange rate from euro US dollar nearly to parity, because then I don't have to care anymore about dollar and euro. So that's only for simplification here. Therefore, my current price here is 1.01, so close to parity. So on the ask level, that trader is seeing in the chart on the ask level 1.01 and is pressing the button buy one lot long. Okay, and now we have to distinguish what happens between the two kind of brokers, market maker and STP. So and first, what we are doing here in the first consideration is we don't talk about the price itself. We don't manipulate. We take all prices as they are, no extras in any direction. So what we have to look here on the market maker perspective. So now we are the market maker. Typically, maybe the spread for euro US dollar is 1 bip. And that means if the ask is at 1.01, the bid would be a little bit lower, exactly 1 bip. And that is, let's say, my price here from the market maker perspective. So nothing extra, no changing of prices, no manipulation, nothing. Temporarily thinking, because we are now the market maker, temporarily, when we take the trade, we have already a profit. So PL stands for profit and loss, and temp means really temporarily. That is now 10 euros. That's exactly because of my 1 bip spread. Because at the moment the trader is opening the trade at 1.01, if you would instantly say, hey, fill that order, so he wanted to exit to close the trade, then the bid price would be at here 1.0099. So and I would earn 10 euros. Why I emphasize I? Because we are a broker. So at that moment, we have additional 10 euros on our account as being a broker. Let's look from the STP perspective to that trade. Normally, typical trade conditions for an STP would be spread around 0.3 bips, but there will be a commission of 6 euro per lot. In this case, because we have a lower spread, that ask price would translate to this bid price, and that bid price would finally come out of the pool. How? Is next slide. But nevertheless, let's think about our current situation as an STP broker. At the moment we get the trade, we have earned 6 euros. simply because we get the commission. What I assume here, and that's not correct 100%, that all the commission stays at the broker and all the spread goes to the pool. There are different kind of calculations, but those kind of details, they are not that important for our considerations for that business model here. So let's assume the spread goes to the pool, we get the commission. That's all. So right now it stands like STP broker has €6 as being a market maker. We have temporarily €10. Okay, but first, before we now close the trade, let's have a look to what really happens within the pool. So within the pool, it looks like this here. The picture is taken from the JFD website in this case, and you see already lots of well-known banks here behind, standing behind that pool. In total, it's around 20 or 21 companies like that one here: Deutsche Bank, Citi, Barclays, UBS, Goldman Sachs, and so on and so forth. So really big players in the market, and those are aggregated in here in that, let's call it a gray box. And then now let's think we have that order from our client. Here's a different price. It's not anymore close to parity. What will really happen if we get our order from the client and then we process that order to that pool? It's more or less like there's an auction around that order. So every of those 21 companies here is bidding for my order, and they don't know the client name, nothing. They just get to know, oh, there's somebody he want to buy one lot euro US dollar, and all those 20 give their offer, and what's doing within the pool is simply the best offer gets it. So whoever here makes the best offer for my one lot euro US dollar is getting that order. That's all. And that will be the executed price finally going to the client side. So what's good here is we have this offering process, this betting process, this auction around client orders. And that makes sure that it's a fair process, because you may think if there's only one bank here sitting behind that pool, then it's more or less the same situation than with our market maker perspective. But now we have those pool of companies, and all companies, they make their offers for those client trades, and the best one gets it. So that's a nice idea to have that kind of pooling process. Okay, that's the story behind liquidity pools. And so the question for you, now back to being a trader, is how big is a pool standing behind those brokers or those bridges? And if that is like here 20, that's always a good thing. Because then we have really that auction process behind. But now let's think the trade will be closed. So our trader, our client, is now saying, close the trade. That one lot long euro US dollar. And now I simply want to have two cases. The price between open and close of the trade went north, and that's A, and the price went south, that's B. And so it's in both cases here 0.001, one to the north and one to the south. From the trader's perspective, case A is, that should now be, that's from yesterday, German webinar, is a profit, and B is a loss from the trader's perspective. The prices are the prices shown up in the chart. So at that millisecond, the trader closed the trade, and I took here the prices, let's say, from the market maker, and I translate those prices later to the pool simply by applying the right values for spreads. Okay, so in case A, from a market maker perspective, so we are the market maker. We are the counter side of the trade. Yeah, when the price went north, that means from my perspective, being the broker, I lose 100 euro here. The client is winning 100 euros. Case B is quite simple, simply vice versa. So, but let's stop a second here. So what we see here is the client's profit is the broker's loss, and the client's loss is the broker's profit. Interesting. That's a nice business model. But let's keep it for a millisecond like this. But it's obvious it's exactly like this here. Nothing else. From the SDP broker perspective, if we are such a broker, okay, we handle that order, that we have slightly different bid values here is simply because we have other spreads. And finally, if you calculate it up here, it means in case A, the client would gain 101 euro, and in case B, the loss trade from the client's perspective would be minus 99. That we have a little bit different numbers here is because of spreads, but still, being the broker, I don't care about the trade of my client. In both cases, I still have my 6 euros. Those I have already at the open of the trade. Good. So looking to that here, and we ask ourselves, what kind of broker should we be? Market maker or SDP? First thinking, we should go for an SDP broker because we definitely always earn those 6 euros here. And on the other side, it simply depends on the trades of my clients. So if the clients lose money, I earn money, and vice versa. So here, up to now, it looks like let's go for an SDP. Okay, just a question here from you. The webinar is recorded, yes, and you will find it later means tomorrow, on the JFD YouTube channel. So no problem if you want to have some additional information or just for recaps, and you can look to the JFD YouTube channel as well. Okay, now up to now it looks like going SDP is a better choice because then we definitely earn money and we don't care about the market. But let's draw an intermediate conclusion here. So we know SDP always wins. Nice. For every lot we get our 6 euro. And for market maker, it depends on the client. So profits of the clients are losses of the broker and vice versa. So it depends, we might think. But we will see the story is better for the market maker, but that comes a little later. Now let's turn our business to an egoistic business model. What does it mean if we are an SDP? Then we should think my clients should trade as lot as possible. So as much as possible. So that's what's good for my business. So if I'm an SDP broker, my clients should trade because I get my money via the volume. And as a market maker, I have a simple attitude here. For me, as being a market maker, it's good if my clients make bad trades because then I earn money. Let's stop here a moment. What does it mean? This means we have a very strange business situation here. Normally, if you talk about business or any trading activities, and now I mean with trades not only what we do here with forex trades or whatever kind of trades, I mean with any business in our overall life, normally we always prefer what we call a win-win situation. Just as an example, if I go to the next restaurant and order a pizza, then I will get hopefully a pizza, and hopefully it's a good pizza, and I will pay some euros for the pizza to the waiter. But it's a win-win situation. I get my food, and of course I pay for my food, and so the owner of the restaurant gets money as well. That's what we call win-win situation. In this case here, being a market maker, it's not a win-win situation because we have that asymmetry here. Like, clients' losses are my profits and vice versa. Hey, that's really strange. And normally, honestly, I could even stop the webinar right now here because now everything is set. But let's be a little bit more creative of what's around that kind of things. So let's first, because we see here, market maker, so it depends on my client trades. Good. Let's have a look to 1,000 trades. And as always, I have an Excel sheet for that prepared. And what we have here is 1,000 trades being a market maker, so MM, and being an STP, and we have an equity from the broker's perspective. So as previously, my commission is €6. We always have a trade, and now I simply make it easy. The trade is either plus 100 or minus 100, and that's all. And of course, you see the red straight line here. That is the equity being an STP broker. It's quite simple. It's just always times 6. That's the equity. And for being a market maker, it depends on how good the trades are from my clients. So if we are at a level of 50-50, of course, we get strange equity curves like this one, sometimes to the minus, sometimes to the positive, as always. But you remember we have had more or less similar kind of charts when we talk about stock markets and statistics, for example. The good thing is already, if we think about a market being totally random, then your first guess, what could be the win rate, so Trefferquote means win rate, the win rate of my clients might be 50%. No, the answer is it will not be 50%. We make our consideration then without spreads. The spreads itself already makes a picture asymmetric. It's a little bit like playing roulette. You not only have the black and the red part, you have the green, yellow as well, which introduces an asymmetry here into the picture, and that break already doesn't make the picture any more fair. In this case, even in a random market, I'm on a winner side because we always earn the spread. When you open a trade as being a trader, you are instantly in the minus. That's the reason. So if we go here down the road with the percentage values, you see, hey, okay, looks good. So if the win rate of my clients is only 45%, you see my equity, being the broker, doesn't look bad. So I can always, because this here is done random, you see I get different equity lines, but on average I get €10 per trade here. I know it's a simplification here, just having trades only with plus and minus 100. There might be trades with different risk-reward ratios, whatever, but it doesn't change the overall picture and the overall numbers. You see, it's not that bad being a market maker, as long as my clients make in majority losses. Hey, that's a nice equity here after 1,000 trades. Doesn't look that bad. And the story is even better. The story is even better for me being the market maker. I make here a summary of two unproven statements, and honestly, they are really unproven, and they are secondhand knowledge, to speak. The first one, I think I can remember where I got that number. I think I have read a report. It was about France. They have made an investigation at brokers, and I don't think that there's any difference between France and Germany and other countries here. And that investigation revealed that 80% of all traders are losing money. Hey, that's good news for us being a market maker. And there's another secondhand knowledge, or just what I picked up somewhere, and honestly, and I mean it really honest, I cannot remember where. There's a 90-90-90 rule of brokerage. And that rule translates to 90% of all traders lose 90% of their invested capital within 90 days. Wow. That's the reason why I write it down here as well. I hope that you are not part of that story, but let's think about this is true. Perfect story for us being a market maker. Because if clients in average lose money, I don't have to worry. I get my money. And if you go back to my Excel sheet and I put numbers like 45% or something like that, and that was already a fun, fantastic story. What if that story goes even worse from the perspective of clients? But that would be perfect for us on the other side. Yeah, but that's how it looks like. So maybe we change our mind. We should be not anymore an STP broker with a constant earning per traded lot, which looks nice as well, but it seems that we would earn much more money if we are a market maker. So let's think about we are a market maker. What can we do else? And now let's get nasty. Let's really be unserious. Let's think what can we do else? And let me first guide you to my last sentence here on my slide. I don't state that somebody is doing it, but at least it's possible. So if we are really that untrustworthy here, then we have a couple of opportunities. We are the market maker. We make the price. That means in principle, we are able to systematically worsen entries and exit of trades. And maybe our clients would not even recognize that we are doing that. You know, and now what I'm saying next is true for both STP and market maker. If a trader is pressing the button buy and he's seeing the price 1.01, we all know that when that order comes to our place, the price is not anymore at 1.01. It's always the next price is the price for that order. And prices change, and especially during events, they might even change dramatically. So if somebody sees within the chart a specific price and then pressing the button that he is not getting exactly that price, is normal. We all know that. And that happens for STP brokers as well as for market makers. If somebody is doing something there systematically, it's hard to realize that. Have you ever looked exactly to at what price you press the button and at what price was finally in your book? It's really difficult. And even if you have limit orders, stop orders, whatever, the the order limit or stop limit is a price when that order is activated. And that means that order is now a market order. So once again, it's not exactly the price of the pending order, which is finally the executed one. So since we are the market itself, so we make the price, we are able to systematically worsen those entries and exits. With a pool, it's difficult to make it systematically because the pool is now driving the price. So thinking really bad, it would mean all the companies within the pool would have to cooperate in order to systematically worsen the price. So it's not very probable that this will happen. So in principle, being a market maker, we couldn't do what is here in the first line. We could do something else. We can try to tempt our clients, for example, with boni programs. So you know that you of course have seen offers like if you transfer 5,000 euros to an account, you get extra 500 euros on top from the broker. The only thing is you have to trade a couple of lots before you can withdraw any money from that account. This is really like a temptation for a lot of people. Think about from a business perspective. If somebody is offering something like that, finally it must be transferred to money in for that company. Otherwise, he would not offer something like that. He's not really opening his own, the owner of the broker is not opening his wallet and give you extra 500 euros or whatever. No, money finally comes back. So if I know that the majority of traders lose money during trading, then I, as a broker, would not lose with those boni programs. So it might be a good marketing strategy here. And finally, just as one third idea here, if we are really nasty, then we know the stop losses and take profits, at least if those being set by the trader. That's a wonderful idea, looking to thousands of accounts, seeing all the stop losses, and then thinking, I make the price. Maybe I should turn the price one bip lower, higher. There's a huge amount of stop losses. That would be an opportunity, so to say. And you all know the answer to that. You call it stop fishing or something like that. We all feel already that we might have suffered exactly that. It can happen, yes. And if we know all those levels, we might use it. Once again, I don't state that anybody is doing this, but at least we have the opportunity to do it. Okay, stop hunting is somebody stating here. That's maybe an even better term for stop fishing, stop hunting. I like it. That's good wording. Good. So that's really if we would get nasty. But let's go back to being serious. We are a market maker and we have a business and we are good businessmen. Good businessmen. And what we have to do is we have to look after our risk because it's not always that easy, like it looks like from first hand. So we have to care about our risk. What do I mean here? What if my clients, once again, we are the broker. We are, in this case, a market maker. What if my clients are in majority euro US dollar long, and the price goes indeed north. What a bad situation. The good thing is, and you remember, if price goes north and all the guys are long, then it might end up in big losses for me. The good thing is, first of all, we only have to care about our net position. There are always a couple of traders long and a couple of traders short. That's good because that balances already my risk. Being the market maker, finally, I only have to care about my net position. So simply the sum of all the long and the short trades in my overall brokerage account. What I might do here is simply, for maybe on an hourly base or whatever time frame you have in mind here, I look to my net position. And if I see bad situations, then I really process orders to the real market. But I would now go to the real future markets because they have better offerings, less costs, tighter spreads. So if I do that, if I bundle my net position and then go with that to the real market, and that's always the future market, so I can hedge myself, so to say. And since I get better conditions there, then I'm charging my clients, so it will not be that worse for me. So even in that case, if the majority of my clients is right, it must not automatically be bad for me because I only have to care about my net position. That cancels already, in most cases, everything out. But in the rare situation that it will not cancel, I have at least something I can do, and that is just processing something to the real market. The other question might be, what if I have some clients who make constantly profits? That's strange, isn't it? I mean, on the other hand, that's what we want to have. Being a trader, we want to have constant profits. And maybe since we are now the broker, we realize that there are some which are, really good. What to do? Even in this case, no problem. We simply have to identify those good traders. And what we do is then we process exactly those orders from those traders to a pool, to the real future market, whatever. And even more strange, maybe, what we can do here is we might even double those trades, and double is just a number here. And since we realize, hey, there are good traders, let's double those trades, and then we have some extra profits as well. There's a challenge, honestly, and that's not easy. The challenge is simply to find an algorithm for this client classification, and it's really called that way, client classification. Looking for the good ones and looking for the normal ones. And then we know what to do with those. So there's a challenge, but the good thing is you remember the percentage values like 80% versus 20%. If we are not extremely good, so if our classification algorithm is not perfect, it doesn't matter that much because we have some tolerance, or we have some buffer for that. For if we are not 100% sure or right for that client classification. So, but in principle, we can manage our risk by processing the net position, at least if that is maybe above a certain threshold and the price is really going against us, which means the price is going with the clients. So we know what to do then. So that means we can manage our risk, and that's good. But the question might be, can we offer something extra, being a market maker, to our clients? And the answer is yes, we can. Since we only care about our net position, as on my previous slide, it means we can reduce swap costs. So those financing costs for overnight trades, because we have two ways to manage that. One, if we have everything in our books and we don't process and give anything out to the real market, then we don't have any swap cost at all, because everything is virtual and only in our books. So we can charge some swaps to clients, and that's simply an extra earning, nothing else. And even if we process a little bit of those orders to the real market, or we only look to our net position, of course, since we are looking to the net position, that's good for us, because then we have not that huge costs there. That means we can offer something for clients. Sounds like a good thing. Keep in mind all the other things previously said. So it's sometimes, and I got questions like, market makers are offering better swap conditions. The answer is yes. You know the reason now, if you didn't know it before. But think and look about on your trades. Think about trade execution. Think about what else goes wrong with your trades, and then draw your final conclusion. So don't forget all the other things. I mentioned this one here because that is the one which seems to be obviously better for market maker. And therefore, that's the reason to mention this here as well. But finally, we are doing a business, and business means we have to do some marketing for our company. And the reason why I mentioned it here is because then you can realize what's really going on in the brokerage scene here, because you see how people are doing marketing. But both sides, market makers and STP brokers, are doing the right things. But now we can identify which is right for what kind of broker. Being a market maker and looking for marketing, it means what we need is lots of clients, maybe lots of new clients, because we need new and fresh money. So what we need is we need marketing with a really big reach. So we need new people realizing, hey, there's a broker. I haven't heard of that. What is the business model, or what is he offering? And so maybe a sponsoring for a football club or something like that would be a good thing for our marketing activities, because we need that reach, and really big reach, to address new clients with fresh money. So that might be our target. Doing marketing from an STP broker perspective is different. Let's, first of all, because we are the broker, let's think about our own interest. What we need is simply clients which trade a lot, because we earn by volume. So that's what we have in mind. On the other hand, it means we need clients which are successful, because if my clients are successful, they will trade more and they will trade longer. So that's what we have in mind when we look to our target clients. So what we need here is a really good mouse-to-mouse propaganda, maybe about our excellence in trading execution, maybe about slippage and positive slippage, negative slippage. Better to have positive slippage here. That is what we need being an STP broker. Or finally, and that sounds always a little bit strange when I mention that, we have to know, being an STP broker, in most cases, we are second choice, which normally sounds bad. But I mean this here extremely positive. Second choice here means simply people come to STP brokers maybe after they have traded at somebody else. And then their second choice is finally a broker which is really transparent and is offering a really fair trading execution or trade execution. So therefore, second choice. But this is meant definitely positive. So we know how to make marketing. We have a business model. We are ready to start our own business. But that's now on your end. What to do next, and that's my personal summary here. And I changed my wording once again here. And on yesterday in the German webinar, there was not only in bold letters the I, it was really the complete name here. But unfortunately, in English, it's only a single letter, so I cannot emphasize or highlight here what I mean really in English. But it's my personal statement. What we know now, the business model of a broker is really quite interesting, and we know the two perspectives of being a market maker and an STP broker. I personally want to make my business, and that it's not only trading, it's any kind of business interaction with anybody, always in a win-win situation and not in a win-loss situation, because then I feel much more confident and much more being treated fair if both parties have a real win-win situation, because then we do all our best on both sides. And only if we have such a win-win situation, I think that's a fair base for any kind of business. Of course, I have to pay something here if I do business and if I do trades, because I get a service, my access to markets and customer support, IT, and so on. But I want to get something in return. And as always, if I pay for something, I want to get an extra value out of that, or at least something in return. And that means I need somebody who is really just, fair, and direct. And by the way, that just, fair, and direct are the three letters of JFD. But anyhow, the conclusion is here quite obvious. Make your own brokerage. Maybe that's the next business model for you. And honestly, it's not that difficult to become a broker. Of course, you need a little bit money, maybe something around 100,000 or 200,000 euros, and you can think about starting such a business. But anyhow, if you don't make your own brokerage now, then my advice is quite easy and simple. Look for a good and valuable partner for your trading activities, and I think then we can do all our best here. You see, being a broker might be a good change of perspective for today, and I hope it has been an eye-opener for the one or the other. Really thinking about trading from the other side, because normally we sit in front of our charts and we press a button, buy, sell, whatever. But now we looked a little bit behind the scene on the other side, what's happening there. And of course, on the other side is somebody who wants to make a business. And of course, he wants to get his own profits. No question, that's business. But we want to be treated fair. I think that's obvious as well. Yeah, that was an unusual webinar. No strategy, no trading strategy. There has been strategies, yes, theoretical strategies from a broker's perspective, not trading strategies for us being a normal trader. That will be a topic in 2 weeks, once again, and all the other ones before, they have been more related to the trading strategies. You will see, comes again. And I hope you enjoyed that change of perspective for today. So, having a good time. Bye bye. Ciao.